Hello and welcome to yet another episode of Crystal Balls. My guest today is an India veteran. He's been running money in India and Asian markets for well over a decade now, several decades actually. Krishna Kumar, Investment Director and Portfolio Manager at EASTSPRING Investments, runs several $100 million in the Indian and Chinese markets. Krishna, very good to talk to you again after a long time. How are you feeling about where the market has reached after it stuttered earlier in the year? Because we've had a fairly pedestrian start to the earnings season this time around, amidst hopes that we'll get 17-18% earnings growth this year. Is that a wrinkle that you think the market will be able to move over smoothly?
Yeah, it's been a bit volatile, and it continues to be a bit volatile. I think the global markets are obviously not very helpful. India, in the scheme of things, is the only bit of an island where we see earnings growth. I have a fear that it's being exaggerated and possibly a bit back-ended. I really hope that the fact that the delivery is more sanguine and probably real in the second half, because the first quarter obviously has not been a great start. I believe that the global markets could get a little more volatile in the second quarter, but I think the second half should be relatively better.
Why do you think global markets will get volatile in the second quarter? Because, there have been many problem pockets which have cropped up in the last quarter or so, Brexit included. Yet the S&P in the US is trading at all-time highs. Markets seem to be just dismissing any of the problem areas which are cropping up. Is your concern related to what the Fed might do, or why do you think volatility will come back later in the year?
So it's a very awkward market. There are a variety of reasons. I'll probably touch upon a few. The awkward bit is the fixed income guys are looking for capital gains, and the equity guys are actually looking for yields. So it's completely warped. The fact is there are a number of events which are happening globally. Interest rates are all-time lows, and obviously that's not helping growth. In spite of being so low as they are, you still don't have growth or any signs of any growth. So the obviously alternate asset that you think about is equities and commodities, where you've got to go and invest more monies because you're not making money elsewhere. A couple of other things which are important, I think, is China, where there is rate action which is pending. Chinese rate action will have an impact on commodities, and that's where one needs to kind of keep an eye. The fact that these changes as they happen tend to become more volatile, and less things which are anticipated, start cropping up. And the reality is, we live in a world which is so uncertain and zero growth, as you see. So it will be volatile because things will settle down. People will look out for assets which are cheap. People will go out and look for materials, commodities, whatever be it. And the fact that, at these zero rate environments, even that is not driving consumption. So it's a very awkward kind of a marketplace, and that's what will cause the volatility.
You would say that the calm that we are seeing in global markets is an uneasy kind of calm then?
Yeah, think about it this way. Even globally, all brokerages are a benchmark. In a bull market, you have volumes which are peaking, topping the previous highs. A classic example is the Indian markets. The foreign brokerages are running at about 30 to 50% below previous year volume levels. It suggests to you that there is very little participation. And the fact that it is running away or going away wherever it is, the fact that there is retail money chasing it somewhere in some form or the other. And so that's what is causing this kind of a bit of a turmoil.
Would you go as far as to say that valuations right now, having reached where they are, without any evidence yet, though the hope is there, any evidence of a significant earnings turnaround, have reached uncomfortable levels? By some benchmarks, even assuming 15-16% growth this year, you're probably trading at 19 times current year's expected earnings. Is that stretching it a little bit in the fairly dodgy global environment that you described just now?
Yeah, so India has been a hope trade, and we have had several bull markets or bull phases on the base of hope. And this is one more which is kind of really running away. So if you break up the overall earning estimates or expectation and go behind the numbers, there are 3 or 4 key sectors which are supposed to drive the 20% kind of earnings growth that we will see in possibly 17, which I'm very doubtful about. Financials, industrials, and materials are the key sectors where you will see, or apparently the forecasted numbers suggest are going to be phenomenal growth numbers. In the environment that we are in, I think the bets are a pretty even call. I'm not sure whether these numbers are achievable in the environment that we are in. What can change and what can kind of revise and is possibly a more aggressive simulated environment by the local government, which is imminently possible. The fact that you could have a kind of an industrial recovery through capex of public sector enterprises is possible, and that could trigger a bit of operating leverage, and hence earnings could kind of come back. I'm really worried about financials, and I think the fact that these guys trade at valuations where everything seems to have been washed away and it's a good world to be in, I think it might be a bit of a trouble spot.
You raised the issue which everybody would be talking about today, Krishna, after the Axis Bank numbers, because every quarter we say the problem has been ring-fenced, it's behind us, and it's time to re-rate these banks. Yet up comes more slippages, even in the blue-blooded private banks, forget the public sector banks. And financials is such a big part of the market, Krishna. Do you worry that the market is ahead of itself in valuing some of these names?
If I say I deeply worry, I wouldn't exaggerate. I think some of these banks, private sector banks, are pretty late in recognizing and acknowledging problems. They've been told several times that these are real issues. Global commodity collapse is a real problem, and they need to kind of cover themselves or acknowledge issues in terms of problems that they have. The second part is, I think their growth in the last 3 years, for whatever drama that we might kind of talk about, these guys have been growing retail loans at the rate of about 20-25%. The much often repeated comment that they are getting share from public sector banks looks like a little misplaced. The fact that they have the same amount of NPLs as public sector banks, just the public sector banks have disclosed and private sector has not yet. The other bit is that loans to NBFCs that the private sector banks have been giving out. I'm sort of moving away from the industrial bit where the trouble is big. The second bit is the NBFC and the retail LAP stroke mortgage and stroke other things which have been given out to retails. I think that is one area where I think one needs to be very, very careful. It's very suspect. NBFCs are trading at about 4 to 5 times book, and those numbers are staggering. And the fact that the banks have got increased exposure to NBFCs is a kind of a bit of a tricky place.
Are you expecting a valuation compression in the financial end of the market then?
So the valuation compression is pricing in a fair bit of, valuation is basically pricing in a fair bit of optimism. And the optimism stems from multiple parts. The first part is obviously there is policy changes which are happening in the side. Second bit is there is monsoon, which kind of invariably drives up more optimism than it should. The third bit is obviously there is expectation that the recovery will kind of play out with operating leverage. Now, all these are priced to perfection in a way that the margin of safety is clearly much more diminished in the global world or the environment that we are in.
You spoke about 3 aspects which should be able to drive 20% expected growth, which you are circumspect about: financials, industrials, and materials. What about the other 2, industrials and materials? Do you think they will deliver as the street is expecting, leading up to that or adding up to that 20% growth this year?
Yeah, that's the interesting part. So if you're thinking of an economic recovery, which the market is pricing in, if you're thinking about the second half is going to be better than the first half, if you think that the public sector capex is going to be a reality where we see early signs of capex coming through, if that comes through, if the industrials play out, there is tremendous operating leverage, both in industrials and materials. They are all working at about close to 60-70% utilization. If the capex cycle starts, which will have to start through public enterprises, because the private enterprises are in a naughty corner. They just obviously can't do anything. The public sector enterprises will have to drive capex, one. Second is operating leverage will kick in. And if that happens, your system is back on a roll, which means that you can actually see numbers which can surprise pretty much. But industrials and materials, can they kind of take the entire industry or the entire market to make it look good? Maybe not. It is a bit worrying that this will get the system back on a roll, but our economy is a large economy. It is not something which is switch on, switch off. It will take some time. It will take a few quarters to kind of build it up.
At this point, a quick break. I'll return with Krishna Kumar on Crystal Ball in just a couple of minutes.